Hello everyone, welcome to the new episode. Today we'll start partnership account, and this concept is for all ISC, CBSC, IGCSE and AS and A level students. So let's look into what is partnership. A partnership is a formal agreement. It's a formal agreement between two or more parties to manage and operate the business, and to share its profit and losses at the end of the year. Okay? So if we had to highlight this, then we can say it's a formal agreement between two or more parties and share profit or losses at the end of the year. Got it? Okay, let's move on to the next one. So when we enter into partnership, we make partnership agreement, and it is sometimes also known as partnership deed. Okay, so partnership deed is a basic document which will help us to divide profit and losses at the end of the year. So let's look at this one here. So is a contract. Excuse me. The partnership agreement is a contract. It's a contract between two or more business partners. Okay. So when they enter into partnership, they make a contract, and that contract gives you the outline of rights and responsibility. Yeah? So what are the rights and what are the responsibilities of the partners? It also tells you how can you share profit and losses between partners. It gives you the general guidelines of how can you share profit apart from your profit and loss share ratio, like how much interest to be charged on drawings, how much capital partners should contribute, okay, and things like that. So in order to do that, we need to make partnership agreement, but if we fail to make partnership agreement, then as per Partnership Act 1890, this is for IGCSE and AS and A level students. Partnership Act 1890 comes into play, okay? And Partnership Act 1890 says the partner should contribute equal amount of capital in the business. So if I invested 50,000, my co-partner should also invest 50,000 in the business. And if partner has given loan to partnership, then he or she is entitled of 5% loan. No interest to be charged on partner's drawings. So if partner withdrew money from business, we should not charge any interest on their drawings. And partners are not entitled any interest on their capital as well. Okay? And other one says, partners are also not entitled of salary. If partner is working full-time in the business, he or she is not entitled of salary. And then the last one says, profit or losses are to be shared equally amongst the partners. Now here's a sample appropriation account that I have prepared. Appropriation account is prepared to distribute the profit for the year according to the said profit and loss of deed. Okay, so that profit partnership deed says how to apportion the profit or how to divide the profit, and this is how we do it. So first we'll start with profit for the year, which we can get it from income statement. Yes, so this can be derived from income statement, and then after that, if there is an interest on drawings in partnership agreement, then we calculate that interest on drawings. Okay, so let's say, for example, partner A and partner B both took money from business, and this is their interest amount. So we add this together, and then we write down this figure here, and we add this figure with the profit for the year out here, and we get this total amount here. Now, after we get that total amount, the first thing that we need to subtract, or we want to subtract here, is interest on capital. Okay, so if we are giving any interest on capital, if partnership agreement says that we have to give interest on capital to partners, then we subtract interest on capital. First we calculate that, and then we subtract interest on capital. So in this case, let's say these are the two amounts for interest on capital. We add them together here, okay? And then now we'll subtract this figure from this total amount out here, okay? So once you subtract, you get another number, yeah? And from that figure, we want to subtract if we are giving salary to a partner, okay? In this case, let's say partner A is getting salary, so I'm subtracting partner's A salary, and this is the remaining amount. So this amount sometimes also referred to as profit available for distribution, or profit available to give away as a share of profit. Now, that amount will be shared amongst partners in the profit sharing ratio. If sometime it could be loss, sometime it could be profit. So in this case, it is profit. So partner A and partner B is getting their share as per their described ratio. So in this case, we add these two amounts, and this amount should be equal to this amount so that we don't have any balance remaining in this account. Okay, so for our reference, I have made some partnership agreements. Okay, so this is a sample partnership agreement or partnership deed. And as per this deed, interest on drawings is, let's say, 10%. Okay, interest on capital should be 50%. Partner salary is 24,000 to partner A. Okay. And profit and losses are to be shared in the ratio 3:4 between A and B respectively. Okay, so I have made up this sample partnership deed or partnership agreement, and they said something about a partner's interest on partner's loan. Okay, so now here I made a note here that if there is an interest on partner's loan, it needs to be recorded in income statement. Okay, not in partnership profit and loss appropriation account. So let's see, I have made a sample appropriation account. Let's say, for example, if we have a profit for the year after subtracting interest on partner's loan, if there is any. So let's say this is the available profit that we have, 153,650. Okay. Okay, now let's here make some assumption about drawings and capital invested. So let's say capital invested by each partner is 20,000 for partner A and 30,000 for partner B. And drawings for the year is 2,000 for partner A and 1,500 for partner B. Now, interest on capital is charged. Interest on capital is charged to partners in partner's drawing, and let's say partner's drawings is, in this case, 10%, so 2,000. Okay, partner's drawings is 2,000, and 10% of that would be 200. Okay. Similarly, partners B in drawings is 1,500, so 10% of that is 150. Okay. So this is the hypothetical number. I made up this number. So these are the amounts. Now, once I have this number, I add them together, and I add that with the profit for the year here. Okay. Now the total is 154,000. And the first thing that I did is I gave away interest on capital. So interest on capital, we set 50%. So 50% of 20,000, we get 10,000. Okay. Similarly, partners B capital is 30,000, and 50% of that, pardon my handwriting, 50% of that is 15,000. Okay, so altogether, total interest on capital that we are giving them is 25,000. Now, when we subtract 25,000, the remaining amount is 129,000. Okay? Now, from that 29,000, we also said partner A is entitled of salary of 24,000. Okay? It is mentioned in partnership agreement. So partner A is getting salary of 24,000. So when we subtract this salary, the remaining amount is 105,000. So this 105,000 should be divided between A and B in the ratio 3:4. Okay? So 105,000, okay, into 3 divided by 7. So it's a 3:4. Okay? Similarly, 105,000 into 4:7. Okay, 4 divided by 7. So we got 45,000 and 60,000. So this amount is equal, and we don't have any money left in this account. Okay? So two things that we need to note here is partners' drawings is 2,000 for A, 1,500 for B, and partners' capital 20,000 for A and 30,000 for B. So how do we keep partners' capital account? Okay, so partners' capital account is the amount that they have invested in the business, okay, which we have to maintain and see how much each partner has contributed. So there is two methods in partnership. How do we keep? First one is called fluctuating method. Okay, so as per this method, the amount that partner invested in the business, okay, this capital account will change. This capital account figure would change or fluctuates, okay, every year. Now, this happens when there is an addition of capital or withdrawal of capital, or we give interest on capital or profit or salary or commission, anything that appears in profit and loss appropriation account. Okay, if that increases the capital, it will increase. If that increases, then we'll write down, add it here. If that decreases the capital, we'll subtract it from here. Okay, I'll show you the sample for this. Okay, so this is the sample for capital account. So previously we said that a capital balance in the beginning of the year is, let's say, 20,000, 20,000 and 30,000 respectively. So this is the amount that they have, and during the year they withdrew 2,000 and 1,500 from their account. Okay, so in a profit and loss appropriation account, we also saw that we are charging interest to partners, okay, which is $200 and $1,500 here. And we gave interest on their investment 50%, so 10,000 and 15,000. This is from appropriation account. So partner A is entitled the salary of 24,000, and their share of profit is 45,000 and 60,000. Okay? So if you see closely here, all the circle ones that I have made, it was derived from appropriation account that we have prepared before, okay? And all these tick marks out here is assumed figure, okay? Partner has invested 20,000, 30,000 respectively for A and B, and withdrew amount is 2,000 and 1,500 for A and B. So when we do that, the total on this side is 99,000 for partner A and 105,000 for partner B, okay? So for this, we need to make balancing figure. So we balanced this account at the end of the year, and we got 96,800 for partner A and 103,350 for partner B. So this same figure will be brought down here, okay? So the same figure would be brought down there. The next method that we have is fixed capital method, okay? Here, the amount of capital does not change. So if I make initial investment of 20,000, even at the end of the year, it still remains 20,000, okay? Unless if I give additional investment to the business, okay? or if I make something called permanent drawings. So it says that each partner's capital remains constant. Okay, so each partner's capital remains constant, and this adjustment like interest on capital, salary, commission, or profit and losses will not be shown in the capital account. Okay? So capital account that we have prepared remains constant. Okay, so this will not change. But to adjust all this other adjustment items, we create another account called current account. Now in this current account, we write down all these adjustments. Okay, I'll show you how do we do it. So in our next slide, this is my partner's capital account. So I use the same example. So initial investment, sorry about that. Initial investment was 20,000 for partner A and 30,000 for partner B. So we don't write anything related to drawings, interest on drawings, interest on capital, and things like that. So at the end of the year, their total still remains 20,000 and 30,000. And this figure should be balanced with the help of balance CD here. Okay? And same amount will be carried forward as a balance BD for next year. Now, all the adjustments related to appropriation account will be shown in the current account, okay, partner's current account. Now here, we know that partner withdrew 2,000 and 15,000, and as per our agreement, we are charging drawings, interest on drawings is 10%, which is 200 and 1,500, okay? And interest on capital, we are giving them 10,000 and 15,000. And partner salary is 24,000. Share of profit is 45,000 and 60,000. So at the end, the total of partner A and partner B is mentioned. Now this will be balanced with the help of balance CD. And this same amount that we have will be carried forward here, okay, as balance BD for next year. So I hope you understood how this partnership works and what are the different accounts that we prepare when there is a fixed capital method and fluctuating capital method of capital is maintained. Okay, so this is it for today's episode. I'll see you soon. If you have any questions or comments, please do let me know in the comment section below. Thank you so much and see you next time.